Get Rich Slow with John Wolf. Hey, I want to show you what happens when you combine the best two first-time homebuyer programs in Portland. This is from a real transaction, so I'm going to be able to show you exact numbers. So the two best first-time homebuyer programs that I know about in Portland are MCC, City of Portland program, 20% off all interest for first-time homebuyers. Now, it's important for me to tell you that most loan officers in the state or elsewhere cannot use this program. Something like 100 loan officers out of the 20,000 loan officers in Oregon have bothered to take this class so that you could save 20% off all interest. The second program is HOTL, and long story short, it substantially reduces the amount of property tax you pay. Now, there's only 100 properties a year in Portland that do this program. Bob Sissel is a great real estate agent who does a lot of those transactions. So let's look at the math from this one. Now, this is the real math. So you can see the appraisal actually came back for a little bit more than the purchase price. So great job, buyer, on that one. And basically a $360,000 property with 3.5% down. Now, it's important for you to know that this client had less than a 620 credit score and had a bankruptcy pretty much 2 years and a month before doing this transaction. So you can see the down payment, the base loan amount, the full loan amount because it's FHA, the interest rate, and the payment. Now, I'm going to zoom into the housing expense ratio because that's where we're going to see the first part of these two programs put together. Now, the full loan payment is that $1,712, and then it shows how much insurance this individual paid. The property tax, you see $122 there. The property tax you have to qualify for somebody for a new construction, which this is 1%, but really the real taxes are probably going to be about 1.25%. But because we did that HOTL program, they're going to pay basically $25,000 less over the first 10 years, and that's where that number comes from. So if they had to pay 1%, that would be $300 a month in this case. You also see the mortgage insurance per FHA and the total, but the total isn't really the whole story. So I copy this straight from the automated underwriting, and it's telling us that because we did MCC, we can subtract $242 from the payment, which actually gives us a net payment of $1,876, and that's the payment that the person has to make enough money to qualify for. Now, I want to compare that to what the loan payment would be if we weren't doing the tax abatement, the decreased property taxes, and we weren't doing MCC, and that would be $2,418. That is a huge difference. The number of people who can qualify for a loan at $1,900 a month is much larger than the people who could qualify or afford a loan at basically $2,500 a month. That's about a 30% difference. That's just huge. So anyways, if you want to know how to do these awesome transactions, if you want to support me, I'm a loan officer in Oregon and Washington, give me a call, have an awesome day, and do the whole like, share, and subscribe thing. Have an awesome day.